our presentation is going to focus on reducing risk in a stock portfolio, not even necessarily a trading portfolio, but your stocks in general. So just in case you don't know who I am, my name is Carley Garner. I work as a futures and options broker, been doing it for roughly 14 years, 14 plus, and never had a boring day in this line of work. So I love what I do. If you have any questions or anything, you can either send me an email or give me a call. There's my contact information. If you're on social media, check us out. Facebook, Twitter, Instagram, we try to post. Every once in a while, we'll post charts and comments and things about the markets, but we also post pictures of dogs. So if you're a dog lover, you'll find that there too. Really quick, I am a broker, strategist, and author. I've written a couple of books. I write a monthly column for Stocks and Commodities magazine. Some of our material is featured on Jim Cramer's Mad Money, roughly once a month, sometimes more, sometimes less, but Jim's a good guy. He's nice to us. And we are a brokerage service. That's how we make our living, is through commission, just like you might trade with TOS or NinjaTrader or whoever your broker is. That's exactly what we do. In fact, they're our competitors. We do things a little differently. We offer a lot more service than those types of firms do for a little more money. And so I'm not saying one's better than the other, it's just different. We also have a mobile app. If you're interested, you can download our mobile app. Just search DeCarley Trading in your iStore or your Google Play Store, and you'll get a free trial of our trading recommendations. You actually get alerts on your phone that will let you know what trades we're recommending. I can't guarantee they're going to be stress-free money-making trades, but I can guarantee we put a lot of thought into them, and we've been doing this long enough that we've learned different creative ways to hedge risk through options and things like that. And I think what we're going to show you today will give you an idea of some of the ways that we approach the markets and trading. If you like what you see and you want to learn more about trading futures and options, I've written 4 books. Higher probability commodity trading is a little more advanced. If you're a beginner, you may want to start with the Trader's First book on commodities. They're cheapest on Amazon, FYI. So let's jump into it. Before I do that, I just want to make sure everyone understands there's a substantial risk of loss in trading futures and options. Trading is not suitable for everyone, and that is even true on a day like today when we're talking about hedging risk. Sometimes if you don't hedge risk correctly, or if you hedge risk too aggressively, you might actually do more harm than good. Okay, so what is hedging? Hedging is the practice of taking an offsetting position in a related asset or a security to reduce the risk of an adverse price movement. Most people understand what hedging is in concept, but when it gets down to actually executing it or implementing it, that's where things go wrong. They forget about timing, they forget about various strategies, they forget about options. Hedging is not easy. It sounds easy in practice, but it's not. It's just like trading or speculating. It's a mental thing. What most people fail to realize, or actually I should say fail to remember, is that the futures markets themselves were created for the purpose of hedging. So those markets are there for us to speculate in, but their primary service is to offer people means of hedging. When we talk about hedging, you can also think of it as purchasing insurance. The idea is, as a hedger, we would like to shift our risk to somebody else. It's not unlike what an insurance company does. The person purchasing the policy is shifting the risk of loss or damage to the insurance company. So we can use the markets in those same manners. In that same manner, sorry. So you'll hear a lot of people talk about a perfect hedge. To be honest, this is my opinion, but I've yet to find the perfect hedge. I think it really doesn't exist. If a perfect hedge did exist, other than in our finance textbooks in college, it would eliminate all price risk. Markets are not perfectly efficient. Assets are rarely perfectly priced, and we have to consider transaction costs and slippage and all those types of things that interfere with the idea of a perfect hedge. But we can get pretty close, and we're going to talk about how you might implement a perfect hedge in in the S&P. So for example, the previous presenter was talking about the E-mini S&P, and he mentioned point values and that sort of thing. So we're taking a step back and we're looking at the value of an S&P futures contract in its entirety. So one single S&P futures contract, the E-mini, is worth roughly $145,000 at this particular time. Each point is worth $50. So we're just going to assume that the index right now is at 2,900. I know it's a little above that, but we'll just round for simplicity. So if the S&P is at 2,900, you multiply 2,900 because it's 2,900 points times $50, and you come up with $145,000. So one contract is basically worth 145,000. So when you're talking about day trading in E-mini S&P, just keep that in mind. Every contract you buy or sell is worth, it's basically the same thing as buying or selling $145,000 worth of S&P 500 stocks. So just keep that in mind when you're trading on a margin of $400 or $500, such a big contract. There's a lot of leverage there and it can be very dangerous. So back to our hedging example. Let's say that we owned 145,000 worth of perfectly allocated S&P 500 stock, or maybe it's just an S&P 500 ETF. Even then, I think we can all agree it's not going to be perfect. There's going to be some rebalancing issues going on and all these types of things. But let's just assume that we could own exactly 145,000 worth of the S&P. If we wanted to lock in the price and eliminate all price risk, we could simply sell one futures contract. Once we do that, as the S&P moves up, we're making money in the cash market in our stock account, and we're losing money in the futures market on our long S&P futures, or I'm sorry, on our short S&P futures. But we've locked in the price. You're probably wondering why the heck anyone would do that. Well, the reality is you would possibly want to lock in that price if you thought the market was really, really toppy. And keep in mind, if you sell a futures contract against your stock portfolio in an equivalent manner, just like this, 145,000 versus 145,000, you're still going to make dividends of your stock portfolio. So you're reducing, or actually almost eliminating, all of the price risk while still getting the income from your portfolio. So that's why some might choose to do it that way. In my opinion, this is a little aggressive in regards to hedging. I think there are better ways to do it, but I want to make sure you understand that is essentially the perfect, quote unquote, perfect hedge in the futures market when you're talking about your stock portfolio. Obviously, I failed to mention this, but just want to make sure you understand. So if you sell a futures contract against your stock portfolio, like we've talked about here, you're giving up all upside potential. So the S&P could go to 5,000, and you're going to still make the dividends, but you're not going to make any price appreciation. So in my opinion, the ideal hedge is not perfect at all. In fact, it's far from perfect. I think we can all agree stocks tend to go up over time. In my opinion, they are a little overpriced here, but heck, I thought that a couple months ago and we're still going up. So what do I know? But with that said, you probably don't ever want to give up all of the opportunity, all of the upside profit potential in your stock portfolio, but you may want to give up some of it. So for example, you could hedge some of your portfolio, but not all of it, by selling less than what you own in stock. So for example, if you have a portfolio worth $250,000 worth of S&P 500 stocks, maybe you just sell one futures contract against it, and that hedges a little over half of it while leaving the other half to run. Another thing you could consider is buying put options, which is like buying insurance against your portfolio, or you could consider selling call options, or you could consider doing both. And that's what I think is probably the optimal method of hedging. In fact, you can, if you structure it right and you time it right, and of course, it's easier to time things looking in the rearview mirror than it is in real time. That said, if you try to establish your hedge on upswings and pull it off on downswings, I think you've got a really good chance at getting free insurance on your portfolio. Okay, so you probably hear over and over and over on TV or reading in forums, people mention protect your investments, buy insurance, buy put options. I think in theory, the idea is okay, it's good. The idea is you want to take some of the risk off the table and protect yourself if the market completely reverses and falls out of bed, similar to what we saw in January and February, well, I should say February of this year. But the problem with it is buying insurance outright is very inefficient. It's not unlike how we buy car insurance. Every 6 months we pay our premium, and chances are we never really get much of a payout at all. So we're paying a heck of a lot more money into the system than we're ever getting out. You'll find the same experience if you're trying to purchase portfolio insurance. It's there to protect you from catastrophic losses, the black swan, the 9/11, the flash crash kind of thing. But normal ebb and flow of markets and normal correction, it's really not going to do you a whole lot of good. So you're going to be paying a lot of money every month or every couple months, however often you buy your insurance, and not getting a whole lot out of it. Another thing to keep in mind is if you are buying put options for insurance, they're only going to benefit you if you actually take a profit on them. I cannot tell you how often this happens. People, they have the right idea. They recognize that the stock market's a little overbought. They have a big stock portfolio that they want to take some of the tail risk off of, so they buy puts just in case to protect them. But what happens is if they're right and the stock market does collapse, they're losing money in their stock portfolio, but they're making money back in some of their long puts, just as it was designed to do. But what they do is they fail to actually take profits on those puts. A lot of times, anybody that was trading the flash crash or even trading earlier this year in January, February, everyone kind of recognizes that in the trough, the market was really, really ugly. But within a couple of days or a couple of weeks, the market's often reversing and going the other way, or at least bounce significantly off the lows. And that happens a lot. It happens more often than it doesn't. So if you bought insurance and you watched the insurance pay off, but you didn't actually cash in on that policy, then there was no reason for you to buy insurance in the first place. It didn't do you any good. So it's only a hedge, and it's only going to reward you if you actually sell the puts and take the profit. And unfortunately, it's human nature. People they just aren't comfortable doing it when they're seeing the market going down. They're thankful they have the insurance, but they have a hard time pulling the trigger and actually taking the profit on that insurance because they always feel like it's going to get worse. And I mean, it's not their fault. It's human nature, like I said. And also, if you turn on the TV during any time the market's in correction mode, they make it sound like the end of the world is coming. So just to give you an idea of how inefficient buying put options are for insurance, it's basically the equivalent of buying catastrophic insurance. So it's really going to pay off in extreme scenarios, not normal scenarios. So you could go 2 or 3 years without your puts actually providing some sort of a return. I mean, that's possible, at least in the environment we've been in. We've seen those sorts of things where the market just goes up and up and up and up and up, and the pullbacks are few and far between. So it's very conceivable to assume that somebody that's religiously purchasing puts to protect their portfolio could have spent a substantial amount of money. To give you an idea, this was a couple of days ago, so these are just examples. I'm not saying that these are current prices, but with the S&P at 2,900, an option that expired in 60 days would cost you about $1,250 to purchase an option 75 points out of the money. Now keep in mind, you're paying 25 points, which is $1,250 in real money. You're paying 25 points to insure yourself below 28.25. So that option doesn't actually even pay off unless the market's below 2,800, because you have to recoup what you paid for the insurance. Insurance isn't free. So to put things in perspective, the market has to drop 100 points in the next 60 days just for that insurance to really kick in. Now that's a simplification. It's not quite like that. If options do increase in value, if let's say that the market dropped 100 points in five days from now after purchasing it, that's a different story. The policy probably would pay off for you. But if we're talking about at expiration, the market would have to be 100 points lower just for you to break even. The 2750 puts, which are roughly 150 points out of the money, only cost $750 or 15 points. But again, the market has to drop to 2735 at expiration just for that to even be worth your while. You can imagine, more often than not, you're just throwing money away. This is, again, a rough estimate and a simplification. These things change with volatility and market conditions, but an estimate of insuring $145,000 worth of S&P stocks for a decline of 100 points or more for 60 days, 2 months, is probably going to run you at least 1%. In more volatile markets, it'll be a lot more than that, but in today's market condition, 1% or 4% annually. So to insure yourself against a decline of 150 points or more, you're talking about roughly let's just call it 2 or 3% annually. So you can see if the stock market generally only moves 8-9% a year, sometimes a little more, sometimes a little less, and you're giving up half of that to insure your portfolio, it's really just, it's very inefficient. It's not the right way to go about it. But what I'm going to present to you today is an idea that will give you the possibility to purchase free insurance, and that's right, I did say free. Almost free. There is an opportunity cost involved, but the cost is truly free, aside from maybe some commissions and stuff. So what if I told you could get the same insurance that we just talked about being extremely expensive and inefficient for free? You can do this, and you can do this by purchasing puts but in the amount of stock exposure that you wish to hedge. So again, if you have $150,000 in S&P stocks, you'd look to buy one put option in the mini S&P, and then to pay for that option, you could sell a call option. And you can choose a strike price. Generally, you want to try to choose strike prices in which, when you're selling the call, the money that you collect is bringing in enough premium to pay for the put. And you also want to give yourself a little bit of breathing room. What I mean by that is, when you're selling the call, you're giving up all upside potential in your portfolio above the strike price of the short call. So you don't want to sell a call that's right at the money, because then you're basically, sure, you can buy free insurance and that's great, but you're giving up all upside potential, and that's not what we want. Again, stocks generally go up over time, at least in the very long run they do. So again, selling a call, using the premium to buy a put, and the result is free insurance. You're mitigating your downside risk in exchange for capping profit potential. And if you do this on an upswing, you'll find that you're capping your profit potential is probably not that big of a burden, because you may give up anything more than 2 or 3% over the next couple of months, but the market generally doesn't move that fast anyway. So to clarify, when I talk about free insurance, I'm talking about no out-of-pocket expense. It's free in regards to money, because you're selling premium and then you're using that premium to buy your insurance. So there's no cash cost, or at least very little, depending on your fill prices and which strike prices you choose and all that kind of stuff. But there's an opportunity cost, and that is capped profit potential in your stock portfolio. And there's also another cost that doesn't seem obvious, and that's the margin cost. So when you're trading two asset classes, now keep in mind, we are trying to protect our stock portfolio, and we're doing it using a hedge that we're creating in the futures market. And by the way, you probably can't create the same type of efficient hedge in the stock market. So if you think you're going to use ETFs or options and all that kind of stuff, it's probably not going to work out the same, especially because stockbrokers generally require very large accounts to sell options and that sort of thing. So with all of that said, we're basically using two asset classes. We're using the futures market to protect our stock portfolio. What that means is you're running two separate brokerage accounts. There are brokers out there that will allow you to trade both at the same brokerage. They're what's called broker dealers. That said, you probably don't want to do that. If somebody is a stockbroker and they offer options on futures on the side, but it's not what they do, they probably aren't very good at it. They probably charge higher margins. They don't have any support staff. Honestly, if you're going to trade futures and options, whether you're using the markets to hedge or to speculate, I highly recommend you actually go with the broker that specializes in that. It's like, I say this a lot, but I'm gonna say it again. It's like going to a Chinese restaurant and ordering a hamburger. They're gonna serve you a hamburger, but it's not gonna be what you imagined it to be. It's not gonna be that great. So if you're going to do this thing, you're gonna need two separate accounts. And the downside of that is you're gonna have to have margin funds in your futures account to execute the hedge. So you could probably do it with his one contract, which again hedges about $145,000 worth of stock. You could probably do it with about a $5,000 to $10,000 account, I'd say. Preferably 10,000. That way you don't have to worry so much about margin calls and that sort of thing in your futures account while you're hedging your stock account. So even though you as a personal investor, once your hedge is on, you're making money in one account and losing it in the other, or vice versa. So you're not feeling too much pain and you're protecting yourself and you're all square. Your brokerage firm doesn't see it that way because your futures account could be losing a lot of money while your stock account's gaining. But trust me, your futures broker doesn't really care what you're making in your stock account. They want to make sure you have the margin in your futures account available to meet the exchange's needs. So that is a little bit of an opportunity. Well, that is an additional opportunity cost, is you have to have a second account going and you have to have probably at least 5,000 to 10,000 in that account, not earning interest or anything like that, just there to execute your hedges. But I think you'll find that when it does pay off, it's probably going to be worth your while. Imagine having a nice free hedge back in February when the market collapsed. It would have probably resulted in a much more comfortable couple of weeks. Okay, so timing does matter. I don't want people to assume that you're hedging, it doesn't matter, I'll just throw it on. Timing is very, very relevant. You really want to put your hedges on when you think you don't need them, when the S&P is moving higher. And you really should offset your hedges when you think you need them the most, when the S&P is down in the dumps. It's really hard to do because we're humans and we don't think that way. Our brain wants us to do something else, but that's truly your best bet. And again, if you never exit your hedge, there's really no benefit of doing it. This is an example of, this is in February, and this black line here is the E-mini S&P when it rallied up to massively high levels and then completely collapsed. So somebody that was savvy enough to buy a put option here, this red chart is actually the June 2400 put. So this is a put option, the red, and then the S&P futures is in black. As the S&P futures marches higher, the put option gets cheaper. Let's assume that someone was savvy enough to purchase a put or purchase insurance against their portfolio right near the highs of the S&P. The value of this option went from roughly $10 to, which is like $500, to roughly $140. At that point, it was a paper profit of $6,000. So their $500 insurance policy paid off huge. For $500, they ended up making $6,500. That's exactly what that insurance is there for. But if they failed to take that profit, look what happened. The profit just disappeared. And the option went all the way back to what it was before. So it was great to time the option purchase perfectly and to buy your protection, but if the trader never actually sold the put, it did him no good. It just cost him $500 for no reason. He may have been a little more comfortable during the turmoil than other people, but ultimately from a investment perspective, he was worse off. He would have been better off not hedging at all because he didn't take his profits. So again, timing is important. You're going to get better insurance and more efficient insurance if you execute your hedge while the market's expensive and take your hedge off while the market's cheap. You're going to have a higher cap on your profit potential. You're going to have a higher level in which your protection actually kicks in, and you're less likely to incur margin issues in your futures account. So it's really simple. Hedge when you can, not when you need to. Don't wait until the house is on fire to buy insurance. So I know we're kind of running short on time, so I'm going to be real quick here. Let's just take a peek at what a long hedge might look like. and how inefficient it is. A trader that's purchasing a 28.25 put, this is the exact same example we talked about a few slides ago. Somebody that purchases a 28.25 put needs the S&P to drop this far just to break even if they hold it all the way to expiration. Again, buying puts outright and just hoping that they protect you if the market falls out of bed is very expensive, and in the long run you're going to end up paying so much money in premium and insurance that your stock portfolio as a whole is just going to be dragging. That's not the goal here. The goal is to protect the portfolio, not make it worse. So the other option would be to sell futures against your stock portfolio. And that's going to basically lock in the price immediately. So once you sell a futures contract, you're basically giving up all upward potential in your portfolio, but you're protecting yourself point for point on the downside. So that's as close as you're going to get to a perfectly hedged portfolio. But keep in mind, if you are perfectly hedged and the stock market drops, you're still earning dividends. And even if the stock market goes up and you have no upside potential, you're still earning dividends. So there's that. But I think, like we mentioned before, I think we can all agree you don't ever want to really give up all of your upward potential unless you absolutely think that there's no way the market can go any higher. We're crazy overbought, and it doesn't bother you to give up a little bit of, a couple percentage points because you think we're going to drop 10 or 20. I'm sure a lot of people have thought that over the last couple of years, and it's probably not paying out too well for them. One day it will, but not yet. Okay, so let's take a better look at the risk reversal strategy. This is exactly what I think is going to be the most beneficial to traders, somebody looking to hedge their portfolio. This trader could have opted to sell a 29.50 call, which means the S&P, this was taken a week or two ago. The S&P is a little higher. Actually, this is a few days ago. But anyways, the trader's saying, I want to insure my portfolio below 28.25, just in case we break below this trend line. Things might get ugly. Who knows? Maybe we're going to here. So I want to protect myself from that kind of a move. And so I can do it for free without paying anything other than maybe a few dollars in commissions. Or if you timed it well and you collected enough money on your call option to pay for your 28.25 put and cover commissions, it truly is free, or maybe even made a few bucks. But you can see you're giving up a little potential here, but you have free downside risk. And in this situation, when the market's already overbought, we're talking about maybe you're giving the market another 1 to 2% in upside potential before you get capped. It's probably not such a bad deal. Markets generally don't go straight up. So if the market rallies 3%, so what? You caught 1.5% of it. You still had free insurance. You slept well at night. So thanks everyone for coming out. Sorry I had to speed it up a little at the end. I guess I lost track of time. But if you have any questions or if you want to learn more about trading futures and options, we have a ton of videos on our website, decarleytrading.com. Free videos, free articles. Our goal is to make sure everybody learns and understands what they're getting into before they actually do. The markets can be treacherous. And once again, I've written a couple of books. These are the most recent. So if you're interested, you can pick them up on Amazon. Free shipping.